Hey, welcome back to my channel, everybody. So excited to be here with you today. And I want to talk to you about a topic that's been on my heart for a bit. And I've had a couple of conversations, and I find that a lot of people are losing hope in ever being able to buy a home, especially since the home prices are so high right now. And couple that with the interest rates as well. Short inventory, a lot of younger couples and people feel they're never going to be able to have that American dream of buying a home. So that can be very true, especially if you were to go the traditional route to buy your home. But there is a way that you could still have that home ownership dream. It be possible, and you could still pay a home, even though there's higher interest rates right now in the market and the home prices are. You still can buy it, or rather, pay it off in about 6 to 7 years if you buy the home the right way. And like I always say, if you borrow the right way, right? How you borrow is more important than the amount you borrow and what you're being charged for borrowing. So that's what we're going to show. We're going to compare a traditional way to do a home mortgage or a velocity banking way that actually will expedite and speed it up for you, make it more cost effective for you when in terms of paying off your home in a very, very short time. So we'll look at what a traditional way looks like first. So traditional, what'll happen is you'll go to the bank, right? And they'll say, hey, we can help you buy your home. Let's do what's called a mortgage loan, right? Mortgage loan. Give some thought. This is some food for thought for you. The word actually means mortgage, means death, right? Mortgage is from muerte, right? For all my Latino brothers and sisters out there, muerte, and then proclamation, right? Or it's also pledge, right? So what are you doing? Well, you are taking a mortgage loan and you are proclaiming a death proclamation on the funds that are going to go to that loan, because you're typically going to have it there anywhere from 15 at the max, with the way the home prices are now, 30 years, right? So this is a traditional way. It's traditional. You go to the bank, they borrow you the money, they do a mortgage, 30 years. And right now, interest rates for 30-year, they're like 6.96. I know the Federal Reserve is meeting about this today, but they're not going to lower rates, in my opinion. They're going to keep them right where they're at. So this is typical for a 30-year mortgage is about 7% right now. So just keep that in mind. Now, where I'm at in Illinois, typical home price is about $280,000. For this example, we're going to use a home price of $300,000, right? So typically, this is a traditional loan right here. Mortgage loan, 30 years, 7%, 300,000. Now, to help avoid, right, a high mortgage payment, most people will look to make some kind of deposit. Well, there's a lot of programs out there. You can get like an FHA. FHA, you can do it right now. I believe it's as little as 3% down. You can go conventional, right? You can use a VA loan. You can use some kind of ARM loan, all different type of loan structures. And they will range anywhere between three, maybe typically a conventional loan is gonna require about 20% down payment. So that's actually the most beneficial. So if we look at this traditional model, we're looking at a loan, 20% down, $300,000 the purchase price. That means that $60,000 is the down payment. Okay, how's that going to help the borrower? Well, it's going to help them, and they're going to avoid paying any MIP, which is another thing that really all it does is it helps the lender. It really doesn't help you, right? They call it mortgage insurance premium or private mortgage insurance. That's just helping the lender. It's not helping you at all one bit, but you're paying the price for it. So the way to avoid that, most people put a down payment. You can put a 20% down payment on a $300,000 loan. That means that you are financing, right? You're getting a mortgage for $240,000. Okay. So now let me do the numbers to that. On a mortgage of $240,000 at 7%, 30 years, we're looking at a payment of $1,596.73. Traditional way. So obviously, we can see here in this example, the person has the cash flow to cover that payment, no problem. The problem is they're going to be stuck in a mortgage over the 30 years. And if indeed they take 30 years to pay it, they would have paid a total of $574,822 for a mortgage of $240, 240,000 over a 30-year period. Not the best use of the cash flow, and they're paying for interest. Remember, upfront. Anytime you do a loan, you're paying for interest upfront because any loan that's amortized, the interest is front loaded. Now, if you borrow the right way, you will help avoid having to pay that interest up front. So now we're going to take a look at the non-traditional way. We're going to buy this home. We're going to utilize a first position HELOC. All right. So if you don't know what a first position HELOC is, that's okay. Less and less banks are offering them, unfortunately. So I always tell my clients, if your bank does not offer you any kind of personal line of credit or HELOC for whatever reason, find yourself another bank. There are plenty of banks. There are community banks. There are credit unions. They will help you. They will help you put this strategy together. Probably someone else can help you with the strategy, but at least they will help you get the right tool to help you eliminate your debt and pay off a mortgage a lot sooner. So this, again, is called a first lien HELOC. Okay. Now with the first lien HELOC, you apply it the same way, pretty much. Okay. We're still going to do a $300,000 HELOC. We're still going to put 20% down, which is $60,000. We're still going to have $240,000 charged against the HELOC. Now, typically, when you go and you get and apply for a HELOC, you'll be offered either a first position or a second position. You want to do this in the first position, okay? Now, with the 20%, putting down the 20%, the advantage that will have for you is most banks, most lenders, when you're going to go and do and apply for a HELOC, you will get a more favorable rate if you go over a specific dollar amount, and that dollar amount is usually about 100,000. When you get a HELOC for 100,000, you typically are going to get the best rates. Okay. Keep in mind, you do have to have a good solid credit score. So maybe somewhere between 700 and over that you'll need in terms of a score. Okay. So over 700. Some lenders may do it a little bit less, but to get the best interest rate out there, you're going to have to borrow at least 100,000, which for a $240,000 loan, you're going to meet that particular guideline. Okay. The second thing that putting the 20% down for you, it helps you stay if you're borrowing, if it's a $300,000 HELOC, right? What they're going to do, or rather a value of the home, what they're going to do is they're going to give you a certain percentage when you take a home equity line of credit. So typically, the closer you are to the value of the home in terms of what you're asking for equity, the higher the interest rate will be. However, with a first lien position HELOC, putting 20% down, that means you are going to have 80% in terms of equity that you're asking to access, right? So 300,000, right? If you put 20% down, that is your $240,000. You take $240,000 is actually the other way around. Take $240,000, you divide it by 300,000, you're going to get 80%. And that's important because at 80%, you present a less of a risk to the lender, which will also help you to get the best interest rate in terms of a line of credit. So you're going to get the best of both worlds. You're going to get the best interest because you're borrowing $100,000 and over, okay, based off what you are going to be already charged against on that first position. And then you're only borrowing at 80% of what's called 80% loan to value. That's how you're going to help keep the interest rate costs down. Now, like I mentioned, there's less banks. Shame on Chase. Shame on Bank of America. Not the most favorable when it comes to lines of credit. However, there are some banks out there like PNC, which is one of the places that I used to work. They will do line of credit. Right now, depending on the timing, right, whether or not, depending on the state you live, you can get some kind of offers for as little as 5.99% for the first 6 months. Is that going to be your case? I don't know. You will have to go to the bank or the credit union. You have to ask questions. This is why I always tell my clients, you have to start establishing relationships at other institutions, especially when your bank is not doing anything for you. So you can potentially get a 5.99% in terms of an interest rate. That is a lot of times is an intro, right? 6 months introduction, and then it starts to adjust over time. But right now, it's not uncommon to get anywhere between 6.25 to, let's say, 7.35 ish in terms of an interest rate for a first lien line of credit, depending on the institution you choose. So this is not too far off than the 7% fixed rate that you're being offered through the mortgage loan. Okay. And what is that doing? That's actually giving you the leverage, because now typically, if we just do velocity banking strategy on the balance of the loan that is owed, which is 240,000, right? And if we start to apply the velocity banking strategy using our cash flow here, our cash flow is $3,002, then we know that in a very, very short time, we'll have that 240,000 paid off. So let's do that. You can technically divide 240,000. And this is pretty much just staying at that particular cash flow, right, over a long period of time. And we all know that as you make payments to your line of credit, the amount of interest that you're going to be paying is also going to be reduced every time you make a payment. So doing that, what that does on average, 240,000 divided by 3,002, you get 80 months, which is 6.5 years. And then in 6.5 years, maybe a little bit more, let's call it 7 years, maybe 7.5 years, but it's definitely not going to be 30 years. And it's definitely not going to be $574,000 worth of interest that you're going to pay throughout that 7.5 years. Because again, as you're making that cash flow payment back into the first line of credit, the first position HELOC, that interest rate is being reduced, the amount of interest that you're paying. So that's basically the two ways that you can actually buy your home. We can see here that this way here, this first position line of credit is going to save you a lot of money. It's going to save you a lot of money. You're going to have a favorable interest rate because you're borrowing more than 100,000. Okay. And you're also keeping the LTV exactly where you need it to be. Now, if you end up borrowing the 300,000, right? Or even if you just stay with the 240, what happens at the end of the 6.5 years when you're paid off with that 240,000 or the 300,000? You then have at your disposal, once again, your line of 300,000 or 240,000 available for you once again. And the nice thing about that, throughout the course of time, you might have a boiler that goes down, your roof might get damaged. Again, if you're here in Illinois, it snows a lot here. You might get a damaged roof. You might need to repair your garage. You might need to install a new boiler system or a new heating system, something like that. You can always just draw directly from your home equity line of credit and save money on cost and interest. And essentially, the home equity line of credits becomes your very own banking system throughout the course of the 10, 12, 15 years that you end up staying at that home. So I hope this video makes sense to you. If you have any questions, comments, or concerns, please put them down below. I try to reply to all the comments just as soon as I'm able to. I do thank you for your time. Don't forget to like, subscribe, and share, and I will see you at the next video. Take care.